Imagine doing everything right with your money, paying your bills, avoiding trouble, working hard yet still getting denied for a credit card, a car loan, or a home mortgage, or worse, being approved but forced to pay thousands of dollars more in interest over your lifetime. What if I told you that this isn't because you're bad with money, but because you're unknowingly following credit score myths that are silently destroying your financial future? Every day, millions of people believe advice like never check your credit score, keep a balance on your card, or close old accounts to look responsible, and they follow it with complete confidence while their credit score quietly drops behind the scenes. Banks don't warn you when this happens, credit bureaus don't explain it clearly, and social media is full of half-truths that sound smart but cost you real money. In this video, we're going to expose the most dangerous credit score myths that are keeping people stuck, stressed, and paying more than they should, and I promise you this, by the end of this video, you will look at your credit score in a completely different way, because one of these myths alone could be the reason your financial goals feel just out of reach. Your credit score in the United States is not just a number, it's a silent gatekeeper that decides how expensive your life becomes. It affects whether you get approved or rejected for loans, how high your interest rates are, whether you can rent an apartment easily, how much you pay for insurance, and, in some cases, even job opportunities. Yet, most people were never properly taught how credit actually works. Instead, they rely on advice from friends, family, or outdated rules that may have been true years ago but are damaging today. The biggest problem isn't having a low credit score. The biggest problem is believing the wrong things about how credit works. In this video, I'm going to break down the most common and most harmful credit score myths in simple language, explain what's really happening behind the scenes, and show you what to do instead so you can protect and improve your financial future, whether your score is poor, average, or excellent. This information can save you years of frustration and thousands of dollars if you apply it correctly. One of the most damaging credit score myths is the belief that checking your own credit score will lower it. This myth scares people into avoiding their credit completely, and that fear alone causes long-term damage. Many people think that every time a credit score is checked, it's treated as a negative mark, but this is not how the system actually works. There are two types of credit checks: soft inquiries and hard inquiries. When you check your own credit score through apps, banks, or credit monitoring services, that is a soft inquiry, and it has absolutely no impact on your credit score. 0. Not even 1 point. Hard inquiries only happen when you apply for new credit, like a loan or a credit card. And even then, the impact is usually small and temporary. By believing this myth, people avoid checking their credit reports, which means they miss errors, fraud, or unpaid accounts they didn't even know existed. Imagine having a medical condition but refusing to check your health reports because you're afraid the test itself will make you sick. That's exactly what this myth does to your finances. Regularly checking your credit score helps you understand your financial position, spot identity theft early, and make smarter decisions before applying for credit. People who monitor their credit are actually more likely to have higher scores because they catch problems early. The real danger isn't checking your credit, it's ignoring it and letting mistakes quietly drag your score down for years. Another widely believed myth is that carrying a balance on your credit card helps build your credit score. This idea has probably cost people billions of dollars in unnecessary interest. Many think that if they pay off their card in full, the credit bureaus won't see activity, so they intentionally leave a balance. In reality, this is completely false. Credit scoring models reward responsible usage, not debt. What matters is that your card is being used and paid on time, not that you're carrying a balance. Leaving a balance does not boost your score, it only increases your credit utilization and makes you pay interest. Credit utilization is one of the most important factors in your score, and it measures how much of your available credit you're using. The higher your utilization, the worse it looks. Carrying a balance can actually lower your score, especially if it pushes your usage above 30%. Paying your card in full every month shows lenders that you can borrow responsibly without relying on debt. The system doesn't reward struggle, it rewards control. This myth traps people into thinking debt equals progress, when in reality, debt just makes banks richer and you poorer. Another destructive myth is that closing old credit cards improves your credit score and makes you look financially responsible. On the surface, it sounds logical: fewer cards, less risk, better credit, right? Wrong. Closing old accounts can hurt your credit score in two major ways. First, It reduces the average age of your credit history, which is an important scoring factor. Older accounts show stability and experience with credit. Second, closing cards reduces your total available credit, which increases your credit utilization ratio, even if your spending doesn't change. This means your score can drop overnight simply because you closed an account you weren't even using. Many people proudly close their first credit card, not realizing it was actually helping them. Unless a card has high fees or causes you to overspend, keeping old accounts open, especially with zero balance, is usually better for your credit score. This myth causes people to destroy years of positive credit history in one emotional decision, often after paying off debt and thinking they're doing the right thing. Another dangerous belief is that paying bills on time is enough to earn a great credit score. While payment history is extremely important, it is only one part of the credit scoring formula. Many people pay every bill on time and still wonder why their score is stuck in the average range. That's because credit scores also measure how you use credit, how long you've used it, the mix of accounts you have, and how often you apply for new credit. Someone with only one credit card and perfect payments may still score lower than someone with multiple accounts used responsibly. This myth creates frustration and confusion because people think they are being punished unfairly, when in reality, the system simply needs more data. Credit scores are designed to predict risk, and limited activity gives limited proof. Understanding this myth helps people realize that building credit is about balance, not perfection. Your credit score is not a judgment of who you are, how hard you work, or how much money you make. It's simply a reflection of the information and habits the system can see. The real danger was never a low score. The real danger was believing myths that quietly pushed you in the wrong direction while you thought you were doing the right thing. Today, you've seen how small misunderstandings can turn into big financial losses. And more importantly, how knowledge gives you control. From this point forward, every payment you make, every card you use, and every decision you take with credit can move you closer to freedom instead of stress. No matter where your score stands today, it is not permanent, and your financial future is still in your hands. The moment you stop following myths and start following facts is the moment your credit begins to work for you instead of against you. If this video helped you see credit differently, take one action today: check your credit, change one habit, and commit to playing the long game. And if you want more videos that break down money the right way, make sure you like, subscribe, and share this with someone who might be unknowingly sabotaging their own financial future. Another common myth is that income affects your credit score. Many people assume that earning more money automatically means better credit, but income is not part of your credit score at all. You can earn six figures and still have terrible credit, or earn modestly and have excellent credit. Credit scores measure behavior, not wealth. Lenders care about how consistently you pay, how much debt you carry relative to your limits, and how responsibly you manage borrowed money. Believing this myth causes high earners to become careless with credit, assuming their salary will protect them. It won't. The credit system doesn't see your paycheck, it sees your habits. Understanding this truth puts everyone on equal ground and shows that credit success is about discipline, not income level. The final and most emotionally damaging myth is that one mistake ruins your credit forever. This belief keeps people stuck, ashamed, and afraid to take action. The truth is that credit scores are designed to recover. Late payments lose impact over time, collections eventually fall off, and good behavior can rebuild trust faster than most people think. The system rewards improvement. One missed payment doesn't define you, repeated behavior does. People who believe this myth give up too early, thinking their financial future is already destroyed. In reality, many people with excellent credit today once had serious credit problems. Recovery is possible, but only if you stop believing the myth and start playing the long game. Credit is not about being perfect, it's about being consistent.